Okay, so we've looked at opening plays. Now what we're going to go and have a look at is profile strategies. These are strategies based around not the open necessarily, but using information from the open, using the developing structure of the day. So essentially these are trades that you can be looking for when the open doesn't provide you something. And so if you treat it like any kind of game that has a start, you then have a middle phase and an end phase, it's a bit like kind of game of chess. There are opening plays, there are opening moves. In chess, you have to take them because it's your turn to play. In trading, you don't. And that's one of the greatest advantages that people always forget with trading. That you don't need to do anything. If nothing shows itself, you don't have to do anything. You let the structure build, you let the information come to you, and then a trade is going to start to develop and start to appear. Now, some days there's going to be many, many more than others. Other days, it's going to be perhaps short-lived. There may be one or two trade opportunities that you get throughout the day. What I want to do over this session is go and have a look at different strategies. What's important about them, how you want to play them, and start to build up a little bit of a kind of process of the important elements of strategies that you need to understand. We're going to develop this more and more and more as we get into the latter weeks in sort of detail. But what I want to try and do here is give you a base to look for certain characteristic trades, certain situations that are going to provide opportunity, and how to approach these. What you want to always be thinking with any kind of strategy is it's all well and good to look at something after it's happened and say, oh, look how this has worked. And you need to understand how they work to be able to understand what you're supposed to do. But what you've got to think about, or what you've got to be very aware of, is what's required at the point when a strategy is about to work. This is your ability to differentiate between something that looks like a potential trade and then whether that potential trade actually materializes. And this is what I want to try and focus on, the details of not just what a certain strategy implies or suggests about a future movement, but also what to expect when that move happens. So do you expect this move to be a more continued move, a short-lived move, a quick move, a slow move? Where do you expect the move to reach? At what point can you start to think, yes, this trade is on? And how do you go about accessing trades? So I'm going to try and break this down. With each strategy, there's a small kind of shorthand breakdown of what it is, and I'll explain the strategy in a little bit more detail as well. This should arm you with intraday strategies as well as what I call sort of a more proprietary strategies that lie in profiles that don't fit the norm. And it's the information that you receive from those and what they tell you about the potential next move that's really important to try and grasp. So, profile strategies then. Like I say, this is all about the unfolding action. It's about not having something that you can do straight from the open. It's using the information you've got, the information that you've also received. And I'll start this off, and the first couple of things I'll show you are things that we have already discussed, but I want to go into a bit more of the detail of why certain things happen and how, what you're expecting to see within these types of moves. And so developing structure is really important because the way a market gets to a point changes the reaction and action that you're going to get at that point. And one of the examples I'll give you of an elastic band is a great illustration of that. That the way something happens, depending upon what's preceded it, is going to influence whether it can actually continue in a direction that you might be looking for or whether it won't. And this is a lot of what using developing and current structure is all about. It's about being able to assess whether something is actually really likely to do what it might advertise it wants to do. The other thing, and I'll get onto this bit first, is timing of movement. So it's understanding where a market can get stuck, where it can accelerate. This way, you can then start to bring in your technical understanding, your candlesticks, your delta, your volume, and all of these things. Bring those things in so that you can now start saying, okay, I'm expecting the market to be able to accelerate here. I feel that it has the ability to move, and now you can transact, and now you're using a setup that leans towards a certain type of movement. Or in other cases, an area where you expect the market to slow down, you can lean on that and lean on that profile to tell you. So it's the profile more is trying to tell you what you're looking for, and then you've got to try and formulate a way of executing that, accessing these types of trades. So like I said, it's about defining the nature of current movement. By defining what's currently happening, you get a much better expectation of what's about to come, and you can then trade from there. We'll go through, as I say, some more sort of what I call proprietary or anomaly-looking profiles that just ultimately don't match standard stuff, and distinguishing what the characteristics of those are. And this is kind of a piecing together of different bits of information that builds these kind of ideas. And we'll look at a couple that are trades that develop over a couple of sessions. Particularly the last two strategies that I'll show you are trades that relate to not just what happened on a previous profile or what's currently developing, but what's happened over the course of the last few days. And this then leads into mapping out structures, and something that we're then going to do together in later sessions as well. So it's about looking at developing structure, assessment relative to what's previously gone on, so previous structure, so you start to pull all these aspects together, and also mapping wider structure. So that's the kind of order flow that we're going to go in here. What do we do in terms of building expectations? What can you do based on the current day? And then we're going to move into wider structures using previous day profiles and then using multi-day profiles as well. Right, first thing, we've talked about this before, the idea of a market falling into a low volume area, what I would call a cave fill. But we didn't go into lots of detail about making this a strategy. And I think we all understand the general concept here. And so what I've tried to do is break these down into context. When do you expect this situation to arise? When do you expect this type of trade to be available? The pattern type as well. So when are you going to be able to play it? What are you looking for when you are playing these types of trades? And what type of strategy in terms of individual trade after trade after trade type strategies can you use? Then we'll look particularly at access as well. That's the crucial bit here. There's one thing to understand what's going to happen, which is your context and your pattern type. Then it's a case of understanding where you're going to get in, how you're going to get in, and what's important to see or not when you get to those points. And then movement expectation. It's all well and good saying I should get in here. You've then got to say to yourself, what am I going to expect to endure? What's going to happen whilst I'm in this trade, and how am I going to have to deal with it? Right then, so with your K-fill, what you're looking for generally, there's two types. Often the easiest one is where you have a double distribution day, this fails to create continuation, and we then end up with a filling in of that low volume in the middle. This is your weak double distribution, market falls into what I would call the cave in between the two higher and lower distributions, and then rotates up and down between them. So what's essentially happened is because the market has no established value, as we talked about with low volume areas, we're going to trade from one side to the other. So straight away, this is a situation where the previous day's profile says to you very clearly, this is what we expect to see. This is an area where the market is going to get trapped, and you can then expect to see bounce from one side to the other. So that gives you your context. As such, what you're looking for is a situation of reversal trades, scalp trades, reversal trades back to the middle of range. And this will serve to then fill that area out. Now, access points, you're looking for extremes. You're looking for the high and low volume at each side, but you're also looking at reversal patterns around those. So it's not just as simple as drawing two lines and say we're going to bounce between these two. In essence, by the end of the day, that is what it's going to look like, or you're expecting the profile to look like. But as the day develops, you have to recognize that you are likely to overshoot these areas slightly. Market is going to rotate around them a little bit, and we're then going to slowly fall back in towards range. One way to think about this is to think about that area as being coloured in. And if you imagine it as being coloured in essentially by a child, that you say, can you colour in between these two lines? And they will colour, and typically, well, a younger child is going to overshoot that slightly. They'll miss, you'll be a little bit outside of the line. And that's what happens to the market. It will slightly overshoot, but it will lack continuation when it does. So this is what you're kind of looking for. We looked at this very briefly previously with your volume fill-in day. Now you can approach this very simply and say, right, I'm going to sell here and I'm going to buy here, and that's it for the day. What you need to focus on then is what do you want to see at these points? It's easy to say, right, I'm going to sell here and buy here. What do you want to see, or what do you not want to see? What you want to see at these points, and particularly in approaching these points, is low volume. You don't want to see lots of volume being done in here. You want to see lots of volume done in the same area, but not lots of volume actually being done on the day. So when you get to the top, you want to see this struggle. You want to see volume fall off very quickly, no increase in delta when you reach up to these points. That's what you're after. You don't even have to play it from there. That can provide you a point for a stop above that VPOC, and you can play it once you fall back inside the initial balance and play back down the range. Likewise, from the other side, same principle. You're waiting for the market to slow down. You don't want to see volume increasing here. If you do have volume increase on the drop, you want to see that fall back very, very quickly. So this might be one where you'd actually pause in taking this trade on, wait for the market to stall, and then buy it. Once again, you're taking it back to mid-range. This is the idea of the colouring in, because if that's your VPOC, we do get a break. This comes on a piece of data, and this is a great example of using data to execute trade. Market drops out of range very quickly, or out of the current established range quickly on the data. This is one where, unless you get a drop and then a continuation move, you're looking to play this back. Based on the fact that previous day suggests we should trade in here, current day has already failed one side and the other of the initial balance. This is not a day that looks like it's got a continuation in it. This is your classic development of a neutral day, which is exactly what you have by the end of the day. And so it's about being able to kind of predict where the neutral day is more likely to appear. And then once again, you have the alternate version that once you come back above the previous low, you play it from there. Now, we talked about this before, so we're not going to dwell on it too much. The other use of a cave, and particularly when you have a more nuanced cave. So this is an example where you actually have a kind of cave in the time-wise, split by the single prints, but within that cave, you have put some volume in the middle. And so if you have this on a shorter time frame chart, you would actually see a period of time spent building essentially a continuation pattern within the larger move. This whole pattern just here is shown on a 15-minute chart, but if you take that down to a 5-minute or a 1-minute, you will have a period of time spent in here where volume builds up within the single print, and then you get the next leg of the move. And this is important to understand, because what this tells you is that on the way back down, there's a potential to fill each of these individually rather than fill the entirety of the move. And so just by looking at the basic single print sweep strategy that we've discussed before, you also have to recognize that when you fall into the minor cave, you will get a fill in, and we spend time trading in this zone, filling this in before you then get the next attempt down, and still the entirety of the zone then trades. So you get the trade of the smaller upper zone just here, and then once you get the break to the bottom of the range, then you get the full two-directional trade within that to fill that cave in. So it's about being able to manage your expectations. With a trade like this, you're falling in from above, so your expectation, as we talked about before here, is for a move through this cave and rotate that area. So rotate up and down, fill that whole area in. But by understanding the detail of this, and if you've seen this trade up here, you're going to be much clearer on specifically what can happen. And so that allows you to manage your expectations of how the market is going to trade in each of those little areas and where potentially it could get stuck. This is a situation that slows the market down, but ultimately doesn't change the overall move. We still get a move that does completely reverse the move that goes up. And what's happened there is the cave has slowed the market down. This is the way I always try and think about these, that it's there to slow the market down. But if we can still generate enough energy and enough volume as you approach the bottom of the cave, we don't have to stay there. The previous example, we open in the middle of the cave and we do stay there. And this is why it's important to know what you're looking for at the edges. When we move on to order flow, we'll start to look more at this, at the kind of absorption pattern. Where do you want to see these types of patterns? Where do you expect to see this type of action? Because when you get that, it's then much easier to say, right, I can expect the bounce back. But if you don't get that, and if you do get the drive down, that's where you step away from the cave and you say to yourself, okay, cave's going, we've done the slowdown, we've spent some time here, and then it's going to go. What I wouldn't expect is a fall into a cave, straight through, and continuation. Purely because of the number of people who look for that cave to hold, to fill in, as we talked about before, because buyers are either going to come in here or here. And if they and so the expectation is there will be some resistance in here, which is going to create this fill in, and then the move is able to continue on its next leg. The other thing that we've looked at as well already is a volume sweep. Looking at the opposite of a cave and using that high volume to sweep through. Again, we have discussed these, so we're not going to go into too much detail on this, but it's about trying to break this trade down into a little bit more detail. So context-wise, this trade comes alive when you have a very tight value area, and it's a re-entry of it. So we know where you can expect this type of thing. This way, you can spot this 2-3 days ahead of time. You know what you're looking for when you get to those points. So what we're looking for then is a liquidation through this area. And what this immediately tells you is that this is likely to be a fast move. This is going to be a move that will zip through, that is going to leave very little volume in that area. So you're going to get this nice quick, smooth move through, which allows this continuation to happen, or at least enables a continuation and potentially leads you to the double distribution that we were just talking about, or the double distribution that potentially can act as a cave. So that's what we're looking for then, this sweep down through. Access points, you've got two ways of approaching this. You have the aggressive sell as you come into the range. And the difficulty with that is unless you have a clear reference point to go into, the falling into the tightly traded value is a difficult one to decide where exactly that sweep down comes from. Whereas if you wait for the market to get inside, then you have the chance to try and play from the top down and take a passive entry within that tight value, that tight area of volume, and then try and play down. Alternatively, you play it down from the VPOC. As we talked about with these types of high volume trades, typically the market does not sweep the entirety all in one. It will do that occasionally, but often it will trade to the VPOC, bounce and through, or through the VPOC, pull back and onwards. So this way you now got an expectation. You now know where you can take this trade on. And so you're looking for this fast move through. You're also looking for a potential exhaustion on the other side, which tells you and allows you to manage your expectations of how long you're going to try and stay in this trade. Some trades, you go into the trade knowing that this is going to be a trade that's going to take time, that it is going to take 2-3 hours to get to where you want, that it is going to do this slowly. Other trades, the expectation, necessity for the trade to work is that it's going to do it quick and it's going to zip through. This is one of them. Once it's done the quick move, you're looking to exit, you're looking for the exhaustion and out of the trade. This is the kind of thing that you're looking for. It's an opportunity in this case here to take the move through this range, so a nice quick whip through the range. This allows for the play to the downside. This is the fast move down through that tight value, and as soon as that's done, the move is over. You then can use the information that's developed on the day to decide whether there is more to this. Do you want to then try and play some kind of passive entry back at the bottom of this range? And that's going to depend on the way we trade here, on whether we are maintaining these areas of low volume. And so as we do that and we come back to an area of high volume, you can look for the absorption. You get that, now you can play onwards. So you're using the initial sweep as a potential trade, but then also asking yourself questions based on how this move has developed, whether this is a market that can still go. And a lot of that, as I'll talk to you about in a minute, comes down to how the day has currently traded. This is a situation where absolutely you can look for the continuation. Reason being, there's been very little time spent here. And then the quick move through. But if the market had spent all day here and this comes late, that's going to be a much more doubted move, and a move that you may well be looking at as straight in, straight out, no more trade. Get out of it and move on, or get out of it and wait for the next day. This is another example of the same kind of idea, and this is a situation where you have a very balanced area of value created during the majority of the cash session. You then get a very late cash session move out, and this is your kind of caught in the hole type trade. It's caught in the hole, you can play the market back down. And so by the time you get back to where the previous range was on the cash session, you're back into this range, which now leaves the chance to drop. So you're looking at this on the open of the cash session. So this is a cash session open trade now, where because of the previous structure, this isn't an open with a gap, a caught in the hole necessarily, because of where you're opening, that's taken away the caught in the hole blanks. You're opening back at value. But because you've got this value to sweep, if at the open you don't see any bounce, you don't see the market rotating away, that's where you can play it straight the way through. Just having that expectation of what's going to happen, so you can then try and play the market accordingly. So that's using previous areas or a couple of previous strategies that we've already looked at as a way of just illustrating what we're going to try and do today. So what we're going to look at now then is understanding developing value, understanding what's currently going on and how you can think about what this means. And as I was putting this together as a way of explaining these types of concepts, this was actually something that started to develop. So I've used this as it was happening and kind of screenshotted along the way. And the idea being here that what you've got to try and do is what I call active scenario development. This is all about saying to yourself, right, with what I've seen so far, What are my potential trades? What is this indicating to me could happen for the rest of the day? So what we've just seen, this is oil cash session. This is the first, this is a 1 minute chart, oil cash session. We have opened in the middle of value, in the middle of range, around about the close of the previous day. So straight away, you've got very little information here. There's nothing to suggest direction based on the previous day. So we're now waiting on what happens from here. We put in a pretty balanced start, and then you get a break towards the upside. Now, the break to the upside comes on the oil data. That's what gives us a drive up, takes us up, smashes out of the initial balance, up over the previous day's high, and we then start to drift higher on the 1 minute. So about 5 minutes of steady ticking higher. So with this information, you've now got to look at this and think to yourself, what are the different scenarios we could have here? You could get a double distribution day. Now, in order to have a double distribution day, we ideally want to hold above this area of volume. So that suggests holding outside of yesterday's value, where you can see the volume starting to build up. So 90.18 becomes your point where you don't really want to see it below there. You're looking for a responsive trade there. So you're building yourself a picture that if you can get responsive trade, buyers keep on bringing their bids up to around 90.18. You don't get sellers pushing down on that. This could be a double distribution day. This could also turn into a trend day. If this move manages to stabilize and starts to trade in this zone here, this could actually be a trend. We may not fall all the way back and start to build value here and leave single prints in the middle. It may well be, bearing in mind that this is still only an hour and a half into the session, that this turns into a sideways range, a bit of absorption, and then you get another initiative break of the high. That's going to set off a trend day. So there's two potential scenarios, and this is what you've got to be weighing up. So you've got to be saying to yourself, right, well, with this information, how do I play this? Based on the double distribution or the trend day, arguably slightly less so with the trend day, any move back towards 90.18 gives you a decent opportunity to play for either of those. And if it fails to drive through the high, you think double distribution. If it drives through the high, more single prints and accumulates higher, you're thinking trend. So you've got a plan already as to what you can look for to play either of those and how you can expect that to play out. Alternatively, you have the reversal. And the reason for the reversal is that we have started the day very balanced. We have started the day inside of yesterday's range. So unless you can develop acceptance higher, this is a day that quite possibly can just get dragged back to where it was. The market was happy in this area yesterday. It was happy in this area at the beginning of the day. And the only reason it's higher is on the data. So unless this data brings in enough buyers to keep the move going, we're going to have a situation where this market can then fall back down. So you've already concluded what can potentially happen. So now it's a question of, as the move then develops from here, what is your decision? What's going to happen now? And so what then happens is, you're looking for more time above 90.18. And this really matters. This is all about the sequence of events. The more time that you trade above here, essentially above the blue box, the more and more it eliminates the reversal opportunity. So when you're going and approaching trades like this, it's not just about saying, okay, I've got these different scenarios. Some of them require fast action. If this is to be a reversal, this needs to start dropping quickly, because the longer and longer it takes to start to turn or to start to drop, the less and less likely it is to drop, because value will start to get accumulated higher. You will start to do more volume here, move the VPOC up. People are not going to be so confident in selling this anymore. So for every minute and every extra bit of volume that's done up here, the reversal becomes less and less likely. So if that happens, then you're looking for potential double distribution or trend day. But if the reversal comes quickly, you've then got the opportunity to play this down. Now, this is a trade where there's still lots of information to be had on the day, and we're still trading outside the initial balance. So if you play this to the downside, if you don't get the buying coming in here, or if sellers are able to defeat that buying, as they do, so you get a sort of more steady concerted sell rather than a slowing down, then you look at this and say to yourself, okay, I can play this back down to here, and then we're going to find out what happens. So this is not a long-winded, large-scale trade. This is essentially a scalp. You're taking around about 30 ticks out the move, 18s down towards 85, 84. Once you're out, you're back onto the top of the initial balance. You have got an open drive. So we've got an open drive up. We're not going to be on a trend day because we come too far back. We've not maintained those single prints to keep going. So trend day's gone. Double distribution day is pretty much gone as well. We're now onto a normal variation day, and this is becoming reasonably clear that that's what we're going to have. So within an hour and a half, an hour and 45 minutes, or actually, sorry, 2 hours of the day, so this is by 4 o'clock GMT, within 2 hours, we've now concluded this is highly likely to be a normal variation day, and a day that is going to continue to balance, bar any more information. And so that's what you're looking for. That's how you're trying to play your day out, and you're using the developing value, developing information to tell you what you're looking for at any point in time. Tell you the likelihood of a move continuing or the likelihood of a move failing, and what that then means for your wider potential structure of the day. Now, the trade that I've just described, or just shown you and talked you through, is essentially what I would call an elastic band trade. And so I'll show you a couple of different variations of this. And by having a name for it, as we'll see when we do more on debriefing and how you build up pattern recognition, having a name that is applicable to you, a name that you understand and that makes sense to you, is a great way to remember things. It's a great way to understand and remember the structure of what's going on. So what we're looking for here, and that one that we just looked at previously was perhaps not an ideal elastic band. It has the hallmarks of an elastic band. What it didn't have is sufficient time and volume built up prior to the elastic band move. So what we're looking for then with these types of moves is that this is something that's going to come generally later on in the day. The reason for that is that when you have a very, very well established value area, you have very well established value for the day, everyone's happy with where we're trading, the market is going to find it much harder to get away from that. Because if all the value's here, to move value up, you've got to not only move away from it, but you've then got to trade a significant amount to build as much value at higher prices as you have at lower prices. Whereas in that previous example, that was quite early in the day. And so therefore you could, even with a pullback, still be able to establish value higher and build a normal variation day. So essentially what an elastic band is it's an intraday caught in the hole. People drive the market away from where it's got established trade, they don't sustain the move, and the market then rips back towards them. And it's the lack of continuation on a short time frame that gives you that potential reversal. And so if you think about what's going on, when you get the fast move away, let's say we go into the downside, sellers come chasing this. They try and sell for the continuation. But if they don't get any kind of pattern to build a trade around, a simple sort of technical continuation pattern, then they're kind of stuck in how they're going to execute. And they're going to have to wait for bounces back to sell into. And so therefore, people are going to start to build positions towards lows. And this is where the telling point of an elastic band comes from. The selling that's going on after the drop, using a falling market as an example, the selling that happens after that needs to shift value lower. And if it can't, you then have the potential for this to ping back. So what you're looking for is a reversal pattern when you see this structure. When you see the large amount of accepted value for the day higher and a sudden sweep lower, if you can't build structure, it's not about building a continuation pattern, it's about building structure and building volume down at these points. If you don't build that, the market can then go back. So you can then very quickly, and the first thought should be, can I find a reversal pattern? You look for the reversal pattern, and the longer it takes for that reversal pattern to sort of come to life and to enable trade, the less and less likely that is to work. So it's a case of time really matters here. The shorter and shorter the time between the drop and the reversal pattern or the reversal access point becoming available, the better. The longer, the more likely that this is not going to reverse. Now, on the reversal, what you're looking for is to start with a kind of steady bounce. The reason for the steady bounce is that after the drop, people are going to sell into the bounce. And it's only once you pass a point where people give up on the sell, on the passive selling, that you then see the rip back up. I'm sure some of you are thinking, I've described something quite similar to this previously, and I have. The delta reversal trade is a great example of something like this. Now, a delta reversal trade does not necessarily have to happen with a caught in the hole. And I'll give you an example of one where it does. So what we're looking at here then, to give an example, is a very, very tightly traded range, an extremely stagnant market. And so what this is telling you is that everybody is more than happy trading here. This is 5 hours of trade in an 8-tick range. There really isn't a great deal going on. So when you get a fast drop, this has to be doubted somewhat. If people wanted to sell, and this is one way to try and think about it, if people wanted to sell, why have they waited until now to sell? There's been no increase in volume, there's no real change in what's going on. So this sudden drop is essentially a trade where somebody has been forced to act, they've suddenly started to sell, everybody else can still see that this is where value is, this is where people are happy trading, and as such, the market is going to struggle to go down without significantly building volume down here and setting up some kind of continuation pattern. And instead what it does is it runs out of volume when you get down to these prices. We don't see a major pickup in volume, and you create this block, not a continuation pattern. And so as you're seeing this develop, you can be looking at that thinking, fantastic, that's where the market wants to trade. We've got no continuation. I can see where I can play the reversal from, and I'm now going to use a reversal pattern, the block reverse trade, to play this back up. Straight away back to where we came from, target the bottom of the range, the middle of the range, the top of the range. And you then get the same thing on the other side. You get the continuation through the range, the sweep of range, and drive to the upside. Now, there's two distinctly different trades here in the execution side, and this is where having the idea of what can happen is one thing, having the execution skill is a different thing. And it may be that for some people, they can't take this trade or they don't know how to take this trade. And it's about learning the different ways that you can reverse, that you can play the move back. So what we've got then, this is a very technical reversal. You have the block reverse, you buy out on the break of the range. So you get a little bit of momentum out of here, little pickup in volume, as you see just in here, big jump in delta. That's enough to allow you into the trade. Whereas at the top, you don't have any structure to play with. You don't have any continuation pattern or reversal pattern, but what you do have is a lot of volume done up here. So from a profile perspective, yes, this is an incomplete move, but it's also a move that is clearly very stretched on the day. It's a market that doesn't want to go down and now is going up. Much, much later in the day, this is not going to be a situation where it can move value very easily. And as such, if the volume done at the high does not translate into continuation, you then have the risk of the market rolling back. And so this is then what I call an absorption reversal trade. And we'll go and look at this when we do order flow week as an example of where you want to use an absorption trade. What you're looking for, how you're going to play it, what you need to see, and how to execute a trade like this. So different trades, there's the pure technical, and then you have your absorption reversal trade, both of which you're trying to play back towards mid-range, back towards where value is very well established. What you don't want to be doing is getting involved mid-range, because as you see, when value is well established, you can move straight through it, you can react to it, you can move straight through it. So it's very, very unclear as to what you're going to do when you're back in that zone. Now with the elastic band, a lot of what an elastic band is about is it's about identifying an opportunity and saying, here's the trade, do you want to take it? And so what you've got then here is a situation where you have previous day well-established value with a tail. The market reverses this in the overnight session, which is this move here. And from that, after that overnight session, the main session, we then trade up here, which is this established value. Now when that happens, we can clearly see that this is a market that's rejected prices lower, albeit rejected it with an overnight bounce, and is then accepting or willing to trade in this same range again. So when you get a sudden drop, and again, this is a drop caused by data, and this is often the case with these elastic band trades, that when you have a market that's very well established and data moves it away from where it's trading, unless that data is significant enough and causes a big enough change to actually generate continuation, this is often the chance to then play that trade back to where it came from, because the market is happy there. Now, if this data had come on the back of perhaps a day that had more of a trend element to it, that was more clearly trading to the downside, then the data could potentially have led to a continuation, because the data is pushing the market in the direction it wants to go, if you will. Whereas here, the market doesn't want to go anywhere, and it is happy to trade where it was accepted yesterday. And so now the data's taking it away from there. And this should be ringing alarm bells and saying to you, look for a reversal pattern. Look for something that allows you to play this move back up. And so this is how this move actually plays. There's the data, jobless data. And on the face of it, on that first drop down, you drop down to around 20. That's not really getting you far enough to look for a causing the whole, not causing the whole elastic band trade. And like I said, you need to wait for something to develop to allow you to play this back up if you believe it is an elastic band. After that first drop, we form a bit of a pennant. So you do have the chance to play back up on the break of the pennant. Nothing comes of it though. You don't get that opportunity and the flag or pennant breaks, the downside move continues. Now, by this point, you look at the profile and you see that this is very, very stretched. We've done double the day's range without moving value in any way, and the VPOC is still very close to the high of the day. So we're in a situation now where we're moving further and further from value. The market needs to do one of two things. And this is where you've got to be thinking about it down here. Either we're going to sit sideways and go again, or we're going to sit sideways and reverse. So we start the first pullback towards the recent resistance, and this is where you're going to get your information from. So with some of these trades, it's not about playing it immediately. And a lot of the open trades we looked at had urgency, they had an immediacy to them. These ones less so. These ones much more about saying to yourself, right, in the absence of a second leg down, we can start looking for the reversal. So you do have time. So yes, I emphasize that the reverse needs to come quick. But when I say quick in profile respect, I'm thinking at least half an hour potentially, if not slightly longer. So once you've had that final whip down and tail down here, we then get this type of move. Once you start seeing clear absorption here, the market holds and holds and holds and holds. Yes, it is creating a bit of a bad low, a bit of a ledge. But what you can then look at is you either have a tight risk to play from here, or you've then got the next leg back up when you get back above 25 to then play for the final move back up into range, which is what you then get here, giving you a target of back to value and back to where the jobless data first came out. So it's a full reversal of the move. Ideally, this is going to be your chance, particularly when you have a pullback, drop, and then when this support comes in and the market doesn't go for it the second time down here, that's the point where you say to yourself, this isn't good anymore. Now I can have a go towards the upside. The elastic band should already be saying to you, unless this charges down here, you don't want to be short, and this is a chance to buy. That's what the elastic band's doing for you. It's basically strengthening a level, strengthening a point that you're looking at and says to you, yeah, you can go for this, you can take this trade on from here. So it all comes down to the elastic band says, look for the reversal, find the reversal. There's a great example. We looked at this in the first week, looking at delta and delta reversal trades. But once you couple this with a profile and you understand what's just happened, that you are in a very balanced market and you suddenly get this drop. The drop then develops a wedge, a delta reversal pattern. And it's not just about the delta reversal, it's about looking at what's happened. Value so well established inside the previous couple of days' value that this is going to really struggle to keep going. And so as soon as you're offered a reversal situation, this is one where you can expect the market to accelerate back. And this is why it's called an elastic band, because the market gets stretched one way. And if you imagine letting go of an elastic band in slow motion, initially it moves steady and then it accelerates up as it snaps back together. And that's what's happening here. Sellers still are going to come in as the market bounces because they're looking at just the drop. They're not looking at where value is. So sellers will start to come in, and as they get pushed out the way, then you get the acceleration towards the upside. That's the bit that you're interested in. So that's the idea behind elastic band. It's about indicators you need to find a reversal pattern. Another example of this, using less of a accelerated move, but instead a slow, low volume drifting move. Same kind of principle, that this drags the market away from value. And because it's slow and light volume, it doesn't shift value higher because we don't do any work to get here. It's more a case of sellers getting out the way as buyers come to buy. So people will come to buy and the sellers will sort of step back and go, well, I might as well try and sell at slightly higher prices, and they just keep on stepping back. And so that allows the market to float up, which is what you're seeing here. It's just steady move. There's no real surge of buying until you start to get up to these areas here, the sort of final part of the move. And so that straight away makes you doubt this move. You then get the absorption at the top. That's saying to you, right, well, you've got the elastic band, you've got the absorption. At this point, this is where you have to think about it. You cannot just sell and say it's going to go down. But what you can think is if this absorption starts to bring in more sellers and starts to tip down, then all of these buyers here are going to start to question the move. If you were long in here, how confident would you be that this is going to keep on going? And so therefore, as the market starts to pull back, those who have got in on this move and thought, well, we just let it drift on, are then going to start getting out. And that creates this reversal, which you can then look to sweep the entirety of this grind up. If we look at then what comes after this, you get the complete reversal. You get the grind up, and this essentially becomes basically a bump and run pattern. You get the bump, run, back down, and then reversal, or continued reversal. And it's all to do with the fact that the market overstretched itself to the upside, couldn't sustain the move. Value does build higher, and that happens because when we fall back, you fall back to where value on the day already is, down at this little red line down there, or the bottom of value on the day, and then we start this sideways action. It's the sideways action there, which is what pulls value higher, allows the move, or allows value to shift higher, but in the first instance gives you the opportunity to play this back down, play it back down, this kind of drifting sweep towards the upside. Right, so next up, what we're going to look at is something that occurs a little bit quicker and it gives you an indication of continuation. So with an elastic band, the important thing there is that what's already happened suggests that continuation of a breakaway is going to be more difficult because the market has already concluded where it wants to trade. With a failed auction, what you're looking at is information that says very quickly the market doesn't want to do that, and so therefore may well be able to do the other. So this is a situation that opens up a potential trend day, a potential directional day. Now, the hard bit with these, and this is why I put the little star down at the bottom, a failed auction is all about an inability to break the initial balance and maintain direction. So the break does not bring in more buyers if it's a break to the upside or more sellers to the downside, and instead falls back inside the initial balance and rotates the other way. Now, the problem is, or what makes this difficult, is it's very rare for the initial balance not to break. And there are numerous day types where the initial balance will break and will not develop into a counter-directional trend move. Think of a normal day. Think of a neutral day. Think to a degree of a normal variation day. Any of those can see the market break the initial balance, fall back inside the initial balance, and then not go and trade through the other side. So it needs to be something that has a specific situation to it that is going to allow for this type of movement. So this is where the preceding action does matter. So context-wise, we're looking for an initial balance break, but you quickly need to get responsive action, and typically you're only going to have a 1 TPO break, so a little spike through the high or through the low. It's going to be something where you should be going into any initial balance break with the expectation of what should happen on the break. If this is a break that could lead to a clear directional move, you want pace, you want volume, you want it to leave single prints and low volume at price. But if you get something that it breaks and it doesn't generate any momentum, then you have this problem with falling back inside the initial balance, and that could potentially be it, and it turns into a neutral day. But what you're essentially looking for, or what this essentially is doing, is it takes the initial balance move and then turns this into an open test drive again. And that's what your failed auction does. So it is a reversal pattern again, but it's a reversal pattern that can then develop into a continuation move. Whereas the elastic band is a finite reversal pattern that takes you back to where it came from, this is a reversal pattern that opens up further movement. And so if you just think very quickly about the timings, elastic bands should be in and out reasonably quick. Failed auctions can potentially lead to a much longer winded trade. I say longer winded like it's a bad thing, a much longer lasting trade, and one that has a potential continuation in it. So what you're looking for then is a clue. When you get the failed auction, I'll show you this in a moment, this gives you a clue that we could well be developing a clear directional move. And the important bit then, it basically puts so much emphasis on the other side of the initial balance that when you go to the other side, you're looking for acceleration. If you get that acceleration, essentially the opposite of what you saw on the failed auction, then you know that a trend move is on. So you have two access points. You've either got the reversal when you re-enter the initial balance, and this is going to be something that's only really playable when you have a very clear reason to want to play it. And the reason to want to play it is not simply it didn't break the initial balance and stay outside. Alternatively, you can then play it on the break of the other side of the initial balance for your continuation there. In terms of expectations, you're not expecting a fast break. You're expecting a break that runs out of energy very quick. Even if it does break quick, you're expecting it to go pop, 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 and then just fail and roll back down. So when you see that, you can very quickly conclude that this move is done, and we can now look for the other side and acceleration there. If you don't get acceleration on the other side of the initial balance, this is probably going to be a neutral day. Now, what's also important is understanding the context of what's happened previously, because this, rather than giving you a situation where you see the initial balance, the failed auction and think, failed auction, I'm going to play it. You more want to be in a position where you're looking at a situation and saying to yourself, a failed auction would be an ideal scenario now. So what I mean, and we're going to talk about the tiring moves in more detail as we get into later strategies, sort of multi-day strategies. But what you're looking at here then is a market that is moving steadily higher. And after a more directional semi-trend move, we've then got a normal variation day. Value does shift higher. It's done on slightly lower volume. Market is beginning to tire of the move. Now, this doesn't mean we have to turn, but what it does say to you is the escape of value on this day and the potential escape of the high is going to be a really important point. This is where you want to see a change. You want to see buyers coming in now to buy, rather than what you're seeing here, which is just a steady rotational move higher. You want to see it more one directional. As such, you could look at this and think to yourself, a failed auction would be ideal, because if I get a failed auction, I've now got the chance to play back against this tired move. So it opens up an early potential reversal pattern, which is what you're getting here. You have a small initial balance, and this little spike out, which is the failed auction just there, essentially creates a double top. So you've now got a double top, just about, a failed auction. This is where then, as soon as you get back inside the initial balance, then you can start looking for a short. Now, you're doing this, volume's still low, but you've already been able to define your risk on the trade as being over this high. You'd know where your entry point is. The closer you can get to the top of the initial balance, the better. And you know where potentially you could see acceleration. And if you see acceleration, you can then play this move for a continued drop to the downside. And so when you get this break, which does start to bring in more volume, this is the acceleration you're looking for. This is completely different to this. And straight away you're thinking, yes, the move down is on. We put in low volume with high volume, low volume below that. This is now a continuation move. But all of that could have been entered here in what would typically look like a very low volume environment, a situation you don't really want to be in. But the point being here that at an area where you're looking for a direction up, you're looking for continuation, you don't get it. And instead what you see is a slow, steady break. As soon as that falls back inside the initial balance, it acts a bit like the IB open, test, now it's time for the drive. So you can enter here or you can enter here. Different skill set for each. One is going to be a more passive entry, one is a much more aggressive momentum entry. Play the break, look for the acceleration towards the downside. Another example, and this is a slightly different variation. Rather than a tired move, what you've got here is a consolidating move. A move where the market has sat sideways. We've built up a bit of positioning, we've built up energy. And again, if you're looking to play the break, looking at this from pure simple candlestick structure, you are looking at this thinking, well, I know where the break is. I know where my opportunity comes. It comes to the break of these couple of highs. So that's pretty well defined. And you know that you've got that in your back pocket, that if you start to come up here with some volume, with some pace, bang, there's your entry. But again, you can look at this and think, well, I've got an ideal situation. I can piece together a bit more story here. If you get a failed auction down, and this, you could plan this, you're thinking, right, if I get a failed auction into this little box, which is essentially a little cave, the cave that you've got, which is only 7, 8 prices wide, is likely to slow the market down. So you've now got an understanding that the market could get slowed down in here. And if it does, this could be a chance for the reversal. If it gets there and slows down, it's also the possibility or the possible chance of it forming a failed auction. that it fails to drop through there because it's naturally going to get slowed down. As a result, you could play it potentially from the middle of this little area, but also as soon as you come out of the little box and back into the IB, that's also the place you can play it from. And if not that, then you're looking for the alternative, different movement when you get to the high to what you saw at the low. If this goes through the high with acceleration, quickly increasing volume, which is what you get on these couple of candles just down here, this is now the point where you can be confident that you are going to get the run towards the upside, that you are going to get this breakout, which turns into a consolidation and a second wave trend move. But all that comes down to, again, being able to look at this and say to yourself, we've got a potential failed auction. A failed auction would be an ideal scenario if it fails to the downside to give a potential early entry for this trade. And it's about using what the early development is to help you in understanding where your trade might come in and giving yourself an early chance. The break of the highs is there all the time. We know what that trade is. What you're looking for is the extra information that might allow you to better position yourself, to give yourself a slightly better entry, to not run the risk of missing your entry there. Because if this is the break that you're looking for, it is likely to be fast because it's going to break highs, start stopping people out. That naturally means this may not be a move that's very easy to get onto. And if that's the case, a failed auction down here and an entry once you get back inside the initial balance is your opportunity to make sure you're in the trade before it happens, rather than missing the action because of the fact that the move through the high, which you can see way before you get there, you can see it building over these couple of days. You know that that is a move that potentially you could miss. And so it allows you to mitigate missing it because the failed auction suddenly says to you, you can go for it now because you can define your risk clearly and you can take this trade on with a bit more security. By the time you get to the breakout point, you're already on side. If it fail breaks this way as well, so you get the failed auction the other way, then straight away you're thinking, okay, another neutral day, I can get out of this trade. And yeah, it's not going to be a great winner, but you might be able to take 7, 8 ticks out of the trade. Similar example of a day that is running out of energy. And this is where you have a complete neutral day. So rather than a move entirely running out of energy, this is a situation where we could go either way from here. Neutral day, close, bang in the middle of range, bang in the middle of value. This absolutely is your classic example of a market could go either way from here, wait and see what happens. And this is why there are going to be certain open types where there is nothing to do. We open, trade straight the way back through value from the previous day, and then within this initial balance, break the initial balance then to the upside. So this is a market that clearly, being involved early on is not a valid idea. You have no idea which way it's going to go. The neutral day doesn't tell you, and the only way you're going to find out is when you go and break the extremes of this day, which you do straight out of the initial balance. So after the initial balance pings down, it then goes through the high, takes out the recent high, which is a poor high as well, takes out that recent high, and then falls back into the IB. So now you have a situation where you've just been given everything you want. You've been told that the neutral day, neutral inside day as well, cannot generate movement to the upside. So it can't generate movement to the upside. Your next thought is, can it generate movement to the downside? So you have the opportunity to sell on the move back into the IB. That's what you want to see. What happens now on the inside day break to the downside? Is it different? Start with, it's the same. It does have the aggressive pop, which is what we had on that failed auction, but it doesn't come back. And so that's the only sort of difficult part of this trade, that as it breaks, you have to look at that and say, right, once this is broken, I need to accept that this could come back to me, and I'm going to have to stop out back inside the IB if that happens. But as soon as it drops and then starts to hold lower, you're thinking, yep, I've got this, it is going to go, I can play the continuation of this move. And you get that sweep all the way back down through a previous tightly packed value area. So that standard sweep the range trade. And it's something that you can always have these types of ideas in the back of your mind, the areas that can sweep through, the areas that can slow down. That's why I talked about the cave fill and the volume sweep early on in the day, about what you expect to see when you reach those points. And that's why you get this quick move down from 50, which comes in here, from 50s down towards 20s and the teens, which come in down here. That quick move down, which is all done within the QR print almost, is all done nice and quick because you've got this range to sweep. So it's about piecing all of these together. Neutral day could go either way. Failed auction suggests we're going down. Once you get to the low, is it different to the failed auction? Yes. Acceleration down. The acceleration down gets you inside of this range. Once you're inside of this range, you can accelerate further and sweep down. So you piece in the story together as you go along. Any of these points you could work out previously. You could work out that a potential sweep is on. Absolutely. You could work out that breaking the neutral day to the downside gives you the potential to move towards the sweep. You can see all of that. You can also see the neutral day to the upside is a flag and a breakout. So you've got these bits of information there. You then wait for the information to develop on the day that says to you, okay, this is now clearly leaning much more towards one than the other. And just give a little bit more detail on it. This is that day broken down onto a shorter time frame chart. So this is now onto a 5-minute chart. And what added to this was the data that comes out at the same time. And this isn't about trading data. This is about understanding the implications that data has for a move that you're looking at or looking for. Excuse me. So what we have here then is you've got that inside day type situation, and we then get various bits of data coming in. You get much, you get much higher French data. So you get a big increase in French data, which gives you a bearish indication. Remember, bearing in mind, this is a bond market, so bonds on positive data should theoretically go down. So what we end up with is we've had the initial breakout, which is the failed, or what becomes the failed auction, but what creates the failed auction is the fact that the data is very, very high. So the high data suggests the market that should go down. Once the market starts to come off, you then get the German data that follows and equally is very high. 56 versus 50, 55 versus 50, very, very high German data, similar with the French data. All of a sudden now, you've got everything you need to see. The German data takes you back inside the initial balance, and that's the point where you can say to yourself, okay, I'm very comfortable to sell this now. Technically, it's saying it should go down. Fundamentally, the data is saying it should go down. Perfect scenario to sell. And that's what you're then after. The sell, the break of the low, the continuation, and you then get this trend type drop. And this is what I mean on the way down. The difference that you see on the way down is rather than the push up doji on the French data, you get push down, consolidate, push on, consolidate, push on, consolidate. And as it's doing that, this is saying to you, absolutely, you should be looking for this to keep on going. This is that low volume continuation move that we've talked about before, where you get these pockets of low volume. It's essentially a mini trend day. It's a trend over an hour, which then is a trend on a wider time frame as well. So that's your failed auction. I think the most important thing with a failed auction concept is that you look at it from the point of view of, would a failed auction be ideal in this situation? So it's a way of getting yourself into a trade if you can see the other side of the potential. So in this case, you could see the potential for the reversal down, therefore the failed auction has a use. And the reason for putting it like that is that you will get many failed auctions or potential failed auctions. So frequently you will see a market that will trade with an initial balance like this, and it will trade out and back in, and you think, failed auction, and it will then trade back out, and then it will trade up. And this is the point where people get themselves in trouble. Because rather than playing for the wider structure and the potential that we've got to move down, all they're playing is it went out of the IB and it came back in, therefore it is a sell. It's too simplistic. You're using the failed auction as a way to enter or enhance the possibility of a different move happening, of the counter-directional move happening, rather than just simply as a way of getting short when it comes back inside the IB. Next up, for intraday reversals, or intraday patterns in fact. This is an intraday reversal on the whole, but what we're looking at here is what we call a 45-degree line, or a fat top or fat bottom profile. This is a situation where a market tries to do one thing, and rather than it tries it very quickly and then fails to find acceptance before reversing an elastic band, this is a situation where the market finds the acceptance and in doing so runs out the ability to actually keep on going. So it's almost an overdone attempt at moving in a certain direction, that the failure to actually generate the move that is needed, or generate the actual next leg of the move, is where the problem comes for that market. Now, I can talk you through this and explain how exactly this works, what exactly you're looking for, and then what this leads to in terms of either the move later on in the session or the move that could come in the overnight session. Now, I first started to learn about this. I was actually reading quite a lot from US traders who were looking at the main cash market, so this sort of cash session, and then trading this type of idea as an overnight trade. So almost a trade that you would take at the close and play as a trade that you would leave on in during the overnight session, looking for the reversal. Now, I think that is an entirely applicable strategy, and it's something that we'll talk about in a couple of the examples, but also viewing it as a situation where this can happen within the day as well. And particularly with 24-hour markets now, this is a situation, because this is a strategy that relates as much to the TPO, so the time profile, as it does to the volume profile. This is a situation where overnight trade, sort of very steady, stable overnight trade, can create this type of formation and then lead to the reversal situation. So let's go and have a little look. What is going on? Essentially, these are reasonably easy to spot because what you're looking for is a very fat-bottomed or fat-topped profile. So a bit of a profile that doesn't have the continuation in it that you would be looking for. Often lacking a tail as well. And so it is akin to a poor high or a poor low without the very clear point to break. So with a poor high or a poor low, you would see a very flat top on the profile. There's a really clear point to break there. Whereas with a 45-degree line, that point is much less clearly defined, and so therefore you don't get this rush on a breakout. So what exactly is happening? Well, what generally happens, we're using the example of a move down, market starts to fall. Now, as the market falls, sellers are going to come in. And what happens is these sellers then attempt to continue to push the market down. And in doing so, what they end up with is a situation where they constantly get absorbed. They get pushed back by buyers. And as that's happening, what this is creating is a situation where buyers aren't driving the market away from the area, as would happen with, say, a elastic band where people take the opportunity to buy the dip or buy or sell into the quick bid and play it back. Buyers are passive and they absorb all of that selling. So what this creates is a lot of sellers who are stuck in a position waiting for the next leg of the move. And this is where the problem occurs, because you get a position build up. And with a position build up, you have lots of people sitting there short, waiting for the action, waiting for somebody to come and sell it to send the move further down. And this is the problem. Sellers aren't forced out. They have no reason to exit. They can quite happily just stay there and keep on selling on a passive bounce, keep selling, waiting for the move to go down. And this is what builds up the heavy or fat bottom. Now, as this waiting game carries on, the market stagnates, you're then waiting for the next directional move. And this can be two directional. So unlike a failed auction where you're looking for the direction the other way, an elastic band where you're looking for a reversal, this can be two directional, and it's about understanding what is going to happen at each side. Now, when you get the reversal of a situation like this, what you're looking for is a steady float back up. So you'll end up with a drop, a fat bottom profile, and then within the day, you end up with this float back. So it's a situation where you don't get, because what could be confused for a fat bottom profile would be a B-shaped profile, a liquidation. But instead what you get is more the fat bottom forms first, and then the inability of the market to then generate the next leg down is what then creates the inverse B, the wrong way, if you will, which is then the reversal of that fat bottom. So what happens is the sellers who can't get the move to keep on going down, eventually as the market starts to bounce back, some will start to exit. Others will then start to exit. As the market pushes up, this pushes more and more people offside, out of position, and more will start to exit, which creates this float up. There's not one point where they're all going to run for the exit. So you get this steady float. For the move down, unlike a poor high or poor low break, this is a move where you have people who are short. People believe in the move down. But what they're not seeing is additional selling, and this is what they need. And because the buyers are creating this 45-degree low, this kind of fat bottom, the buyers aren't forced out. They're not got one point where they're all going to exit. So what you need to see then with this situation is a situation where when the market breaks, this brings in new sellers. And it's their new sellers that generate some more value lower down, which essentially widens or elongates that profile. And that's what can allow the continuation. I'll show you some examples to try and make this a little bit clearer. And as I go through them, think back to what's going on here. to the step-by-step process. Directional fail. So we get a sort of incomplete auction, a fat bottom. You then end up with either a continuation or reversal, and you'll get either a float back up, or you need volume, you need energy, you need acceptance below to keep the move going. To access this, the hard part on trades like this is you need to play it away from the developing value for the move back up. So that reversal point is a trickier one to work out. The continuation is easier because what is required is the high volume break. And so if you don't have the high volume break, you never get the indication that this is the one to take. So rather than it being at a specific point, it's more about the nature of the move that tells you what's going on. And then it's a case of either the float or the acceleration. So let's go and have a little look what we're looking at here. This is a prime example where you don't have a liquidation day as such, you have a small move down, and looking at the TPOs, the letters here, you can draw a very clear sort of 45-degree line. What's going on here is that traders are playing for the move down. They're playing for the break of these couple of lows. You can see where they are just here the last couple of days within the previous day's range, or the previous couple of days' range. So they're playing for this breakdown, but they're not getting it. Buyers are still happy to come in and buy down here, which is what's forming this sort of non-continuation type pattern. Basically, sellers are constantly pushed back. They're not wrong, and this is the point with a trade like this. The sellers aren't wrong here. Yes, they're being pushed back, but they're not wrong. They're not in a situation where they're in any danger. Where the danger could come is on a break of this ledge to the upside. If that happens, then this has given you, in this situation, a nice entry point, a point where you can say, yeah, this market can reverse now when you get through that area. So getting through there, the reversal is then on, and you're looking for the market to then rotate back up. Essentially, everybody who's waiting for something to happen doesn't get it, and they all get forced out. So let's go and have a little look at how this plays. This is what you get. Now, this is a much more dramatic move than one would expect on the back of that 45-degree line. The reason being, it's non-farm payrolls. And so what you're getting here is data that leans into the move. You've already got a situation where this 45-degree low that is essentially created here, if you try and draw it, you can't draw it on your candlestick as easy or as clear at all. But that 45-degree low then creates this situation where the market is skewed up. You're not going to find sellers on the way up because all the sellers are in here and they're in position. So these sellers all come buyers, and that's why the payrolls move gives that accelerated move up. But because this is more liquidation, this is these people giving up, the move's less sustainable. And then you get the reversal back down. Unless you find new buyers up here, this then becomes essentially an elastic band. And so the fat bottom then attracts the market back. We get another building out of this fat bottom. You see it then on a profile perspective, and the next day you can just see the initial balance there. We open and continue the move to the downside the following day, quite simply because you have now the next day got the energy to go. So that's what you're looking at. So it gives you a skew. It allows you to go into this thinking this is not a market that is generating enough sellers to keep on going, therefore I'm in a situation where I can be comfortable to try and play this to the upside. Would you play it to the upside into non-farm payrolls? Realistically, probably not. You're going to have to be looking at this going into the data thinking if I get anything that gives me an indication to the upside, I'm happy to go for that. What you can also get, and this is looking at then the fat bottom break, because rather than just purely looking at the reversal back up, you can have the breaks as well. But remember what I said about a break. This needs to have volume and continuation in it. Remember, the people selling are not exactly wrong, but they're waiting for somebody else to come in and join them. And if somebody else can't come in and join to keep the move going, the move's always going to struggle because the sellers that are already in, if they don't get that continuation, are then going to look to exit trade. And the problem, of course, is that the more people who get short, forming the 45-degree low, the less people there are to sell on the break because they're already in and they're already waiting. So this is what we end up with. This is your pullback move. So we've had this cash session, overnight session, cash session. So these two are your main cash sessions, and then this is your overnight. So overnight, you get the classic caught in the hole reverse. Shift out value, overnight caught in the hole, market falls back, but then creates this 45-degree line, this sort of fat bottom. And you can see it on the volume as well, fat bottom created down here. So this is basically where sellers have taken the move back, and now there's uncertainty among sellers. Do they still want to keep this going down? Bear in mind, they are running into a logical place for buyers to come in at the top of previous day's value, seeing as the previous day was a drop and then reverse. So buyers can come in here. This is what's stopping the sellers gaining any kind of further traction. So you can build up a picture of what's going on just by thinking about what buyers and sellers are going to be doing in these areas. So sellers have taken the chance to play the market back down from the caught in the hole. Next up is now a question of, can they defeat the buyers who are logically going to come in where the value area high the previous day was, or are these buyers going to push back? And when you get to the open, this is where you're going to get the energy. This is where, as I say, you need volume increase. You need some pace to come into the market. And that will be sufficient to defeat the buyers that are holding this up. You will get new sellers come at the open because you're bringing in a whole new category of traders. So as you get to the open, you've got the chance for the move. So you've got the volume comes in, this gives us a drive, but note the volume here. Yes, compared to what's happening in here, it's decent. But compared to what you're normally expecting, look at the volume on the previous open, we're much, much lower. That's the problem. And this is what I mean by you need sufficient volume, sufficient energy on the break to sustain this type of move. Now, when you get a light volume break, yes, it does give you a ping back down into previous day's value. But because this isn't sustained and we're unable to push through and then establish value lower, the move is then going to struggle to keep going. The sellers who are in here are then going to start taking their profit. Because no continued selling comes in, reactive buyers can then start to come in. You then form a fat bottom early on in the day, and you get the reversal back up. So you get essentially a 45-degree line followed by a 45-degree line. Similar example here, and this is then a two-directional version of this type of move. Again, another situation overnight, another example of a caught in the hole that reverses in the overnight session and then can't find any more buyers in this instance when you reapproach the top of value. So same principle, we're looking for an increase in volume at the open that is going to enable the sellers that are preventing this move up, that are causing this 45-degree line to be overcome. And that happens in this instance, albeit once again, slightly lighter volume, or at least the same volume. And then the volume falls off very quickly. You look at how quick we get back down to here, whereas over here, you get a much higher amount of volume for a more sustained period. So you do get the energy and you get this breakaway. You get the drive up, volume then starts to accumulate higher, and you can be reasonably comfortable thinking, yep, we defeated those people who are just selling it and holding it back. Buyers are now in control. Where the problem comes then is once this starts to turn back here. You form a little continuation pattern, we drop back through that below 75, fall back inside the initial balance, so essentially a kind of failed auction type trade. It's not a full-on failed auction because of the time spent above, but it is a situation where it's showing you that this isn't a market that can sustain the move any further. And as a result, you then start to see the drop. And once you get back inside the overnight range, the sellers gain control again. And so the sellers, whilst the sellers are generally coming in late in the day, as they come in here, you're following the same pattern that sellers coming in late in the day take control and do drive the move lower. So this is a situation where that 45-degree line, it's all about the way you break. It's all about whether you have the necessary volume to drive that break to keep the move going. This is the example of, and the first kind of instance where I learned about the whole concept of a 45-degree line. Clearly an undecided market because from the open here in the initial balance, we have traded above and below. So a very non-directional day. You can see that in this profile here. Followed by end of day, a jam towards the low of the day. You can draw the 45-degree line there from the low to the VPOC. And that gives you your very flat bottom. It's clearly not a completed move because you have a double TPO at the low. So it's an incomplete move. But this is exactly the kind of trade that people are looking for, where essentially what it's showing you is sellers, as we've talked about, constantly get pushed back on. They can't generate the move down, and therefore you get this float back. Often an overnight move, because the sellers who are passively trying to push it down late on into the day, the sellers that are coming in around here, once you get past the close, they no longer are likely to be around. Once you get past the cash close, you see that the movement reduces. And then once you get past the US close, this is where the float back can come. And so what you end up with then is this drift up. It gives this overnight dribble higher. People start getting pushed out of their trades. And then when you come in the next day, those people who did sell it late in the cash session down here are now trapped with a gap up against them. They're going to get forced out of trade. So you get this gap and go move early on because of the fact that all of these people selling it down here couldn't get through the passive buyers and the market gets floated back against them. So it's not so much a case that the buyers have been majorly strong here. It's more a case that as the passive selling goes away, once you get past the close, the sellers aren't there for the market to come back up. And so some of the people who are short in here, who start to give the move up, create the beginning of the float. And then obviously some buyers are going to recognize that and start coming in and are able in the overnight session to push this higher, which creates this gap up within range. So something to look out for, and it's a trade there when you come in the next day, see the gap up, you think, yeah, I can see why this can give us at least an early move up the range. Wouldn't be looking for a huge amount because this is still ultimately a gap within range. So it's going to be a short-term continuation. The last people who sold it late in the cash session down here getting forced out of their trades. When it comes to volume and when it comes to the break, there's the one element of the break needs volume to get the business done. To get the break, you need volume to come with it. But you also then need to see that sustain the move, as in you need the volume to drive you through the low, which is your fat bottom. So this is the previous day's trade. So rather than an intraday trade, the previous day you got the classic fat bottom profile, 45-degree line, and then later on in the day, drift up. You get the initial drift up, liquidation of some people who have got short in this zone looking for the drop. That fails. Market then has a second go of moving up. Again, you then get this steady drift higher, which is what creates this deceptive B-shape profile. The easy thing for people to spot here is the shape, and they say, oh yeah, B-shape, that's a liquidation day. It's absolutely not. This is a day where there is liquidation, but it's more liquidation of shorts who are failing to get the move going down than it is longs who have been forced out. If this is a liquidation of longs, classic B shape, you would open up here and trade down. Whereas what we've done is open down here, failed to generate a move lower. And when you can't do that, then the sellers who have got themselves trapped in here trying to get the move down, get forced out, and that's where they give up. So you need energy, you need pace on the break here. You get it in the form of some data again. The data gives you the break, but like that payrolls move that I showed on the first example, this is not sufficient to sustain the move. It's enough to get you through the area, but you then need volume, you need acceptance down at these prices. You need the market to stay down here. If it can do that, wonderful. Now we can keep on going because you're finding new sellers. We know there are sellers here, but you're not finding any more sellers on the drop unless you actually spend time below this low, which comes in at around about 25. So your fat bottom zone essentially runs from 25 to 29. That's the bit that matters. If you can stay below there, particularly below 25, then the move can keep on going. If you can't, you get the reversal. And so this is what happens. This is it on a 1 minute. There's your fat bottom range, the bit where you need the volume, you need the charge through, and you get it. You get the volume. Now you need acceptance. Bearing in mind this is a 1 minute chart, yes, we've still got reasonable volume, but it is starting to fall away. Delta's stabilizing. Need now, and almost you can think of this like an elastic band trade, that you need it to stick down here now. You need it to start to build more volume down here, steady up, take some time, put some volume down here. As soon as it shows any indication that may not be the case, this is where the reversal comes. You get the move back inside that fat bottom, you get this little sort of downward sloping wedge, and then you get the rip back through the range. Because all that's happened here is you've got a few people attempting to play the continuation. But because this isn't sufficient new selling, bearing in mind that many of those sellers now from the fat bottom are now thinking, wonderful, we're on side, let's see this keep going. As soon as it doesn't keep going, you've now got the data sellers who are down here and the fat bottom shorts looking for the continuation, realizing this isn't happening, and this creates the counter trend rush to the other direction. So that's what you've got to consider with this 45-degree. What needs to happen on a break? What do you want to see? What do you need to see when this market breaks? Right, the final intraday trade that we're going to have a look at, or strategy we're going to have a look at, is what you call a machine gun trade. And this is a situation where you have a kind of in-between liquidation and trend. You don't have enough drive for it to be a liquidation, enough of a large initial move. But equally, you don't have the tight single print that is synonymous with a trend. So it's a halfway between situation. So what you're looking for is, you're looking for a breakout early on the first move. So in a rising market example, you're looking for a pop through the initial balance that will snap run towards the upside. Nice, so you get that. And this isn't enough because it doesn't charge on in a straight line and create a P shape. So it's not a liquidation move. Typically, what you're going to have is a very small set of single prints, even just one TPO as your single print. That's an early little identification. That's the trigger, if you will. Now, visually, this looks nothing like a gun, so there's no kind of easy visual representation here. It's about the action that follows. So what we're going to get then is you get this little trigger and you get a semi-liquidation P-shaped looking day. So it's a kind of P-shaped normal variation type day. You will then get the responsive selling, which is what creates the building up of the kind of semi-P looking day. And this will create a sort of two-directional trade. What you then need is, because you have got at least early indication that the buying conviction is slightly higher than the selling, because of that single print and the inability of sellers to actually retake that and get anywhere near the initial balance. This is now showing you that buyers are slightly more in control. What you're then waiting for is that when you reach the high, buyers don't get the passive responsive selling anymore and instead have to accelerate through the high. And it's that drive through the high, that's the machine gun firing, if you will. It's this accelerated move, so you're looking for a more explosive momentum move through the high. So essentially you get a sort of semi-liquidation followed by another semi-liquidation day, which creates this type of profile that has a sort of tail, body, and almost a double distribution on the top of a tail. It's not a full-on double distribution day, and it's not a liquidation or trend. And this is why we have these types of sort of proprietary profile shapes, names, if you will, because you won't see this in a book. It's about understanding what you're looking for in these situations. So when you get this type of pattern, you're looking for, this is full on breakout. You're looking for a breakout play. You're looking for extreme volume through the high, which is the firing of the gun after you've got that trigger developed. And then we're looking for continuation. You're looking for a continuation move, or potentially a sort of continuation. If that fails, then you're going to rotate back towards where the gun fired from. But the first move out is likely to be fast. You want to see this very aggressive liquidation-like move. And so you can play that for the move until it starts to stall, and then you can exit the trade. So it's all about the explosive move. After the explosive move, then it's an assessment of, are you going to get continuation trend-like, or are you going to get the more sort of balanced sort of second distribution building in. So let's go and have a little example here. This is an example where you've got an early little move, and this is what I mean. You've got the chance on a breakout of a couple of days range, you have the chance for a move higher. And you get this one single print. That's your trigger. So it's not a huge sort of liquidation type move like you would expect, or like you might be looking for after this break of a couple of days, a couple of inside or an inside day. Instead, you get this initial balance up. There's your early conviction from the initial balance, but then a steady movement from there. You get one pop higher, and the market then steadily rotates. So you get left with this single print, and that's your trigger. So now you're waiting for the extra impetus, you're waiting for the extra bit of drive that is going to give you the break and the charge to the upside. That's what we're now after. This is often something that is going to come as you enter the next session. So particularly if you're in a European market, as you come into the US session. So it's quite a classic sort of US Open type trade. There's the US comes in, and this is where you can look for correlation as well. Say you're trading stocks in this example, S&P comes in, gives you that drive to the upside. This is where you can get that explosion from, that extra bit of pace. So unlike the 45-degree angle trade or the 45-degree line trade, this is one where, because you have the trigger, that has shown you that the extra conviction actually lies with the buyers, and it's just sellers really kind of responding to the bid up. They're going to get taken out on a break. And so here, what you're looking for, any sudden increase in volume. This is one that's initiated by a bit of data, and so therefore gives you that chance for the move onwards. And you're looking for the continuation until the market starts to stabilize. In many of these machine gun type trades, you will get this. And this is the beginning followed by the second part of the trade. So you get this kind of triple distribution day. Like I say, it's not a full-on trend day because you have this wide distribution followed by one pop and a second wide distribution. Not multiple, but equally it's not a liquidation day. So the important bit is when you're seeing the build of energy in here, you need to be preparing yourself for any momentum event, anything that gives you a change in momentum that allows you to then play for the break of the high. That's what you're after. And you're expecting that to come fast, very aggressive, snap through the high, and then continuation. You follow the continuation move until the energy starts to dissipate, until the volume starts to flatten off, and until you get a reversal structure. You've made some highs, trade above, back below, struggle to get above those highs, classic switch trade, you're out of it. That's the way that you're trying to play these machine guns. You also get, it's like I just talked about, you have the extra volume coming in from a US session. You could have this situation where you have the overnight Asian session running into European. So you get the setup, you get the early indication, which is what's going on here. This is your S&P overnight session. Steady move up, single print, just the one, just in there. There's your trigger on the trade. That's setting you up for the machine gun, for the firing to the upside. And this is what we're now after then. You're watching this steadily ticking up, ticking up, ticking up. You've got break of high, break of previous high. It holds it, keeps that single print in place. That's what you're after now. You're waiting for the open. And because you open just below VPOC, this is the cash session open, split profile. Open just below VPOC, that's then the place that you're going for. You're going for the break of the high. As soon as you break through that high, this is what's going to give you the charge towards the upside. So that's what you're after. You play that break, open, you can play it on the break of the high. That's the firing point, and you know you're going to have volume in this. So because you know you're going to have the volume coming in, you can play for that. And as long as it does the snap through the high, which is what you get, at least on the initial movement, just in here, snap through the high, you get the continuation. Again, once it shows signs of stalling, once the move sets up a little bit of reversal, you can give it up. In this instance, like I talked about that 45-degree trade, light volume open compared to previous. And that's your kind of worry. That's what makes you think, right, you can play the firing of the machine gun up, but don't necessarily expect too much more. And what you get is this reversal and pullback into that overnight range. So make sure when you're going into any cash session, you're looking at what the overnight's done and whether it's set up something like this so that, again, you can preempt these open trades. We didn't talk about these in the classic open trades. This is more something that is a result of a very specific profile type, very specific profile shape. That's when you can look for an open drive. And with these, if you've got the high of the overnight session to play for, that's the one you can go for. You can play it on the break there to give yourself a defined entry point rather than just playing the straight off the open drive. Because if you're opening inside of range, inside of value, yes, the open drive could be on. But there's nothing to stop it doing an open test drive, which is what's going to cause you a problem in this situation. If you had the open test drive, the machine gun idea is still there. You still maintain this single print, you still maintain trade higher and then do explode. But the problem is you will end up a long way offside and likely stopped out. So it's about trying to play it on the break. It's with the momentum that's important. This is the example of using it in the overnight Asian session using currencies. So you haven't talked too much about currencies in some of these examples, but this is a similar machine gun type trade. On currency, you get the early little kick up. So this is your early move higher. Again, it doesn't then generate a trend. We spend much of the European morning building volume up, but the trigger's already been set down here. So there's your trigger. We spend time building volume higher. which could, again, like I say, start to make you think, this is a P-shaped day, small liquidation. But the fact that the consolidation part of this P shape, if you will, is across a previous high suggests this isn't a liquidation. The liquidation would come on a break of the high, and that's not where it happens. The liquidation, if you will, is this bit. And so that becomes a trigger. Now you're looking for that firing through the high again. As soon as you get some pickup in volume, you can go and shoot through the highs. Nice fast move, big pickup in pace, straight line up. This is one where you get a flag instead of a reversal pattern and then a further continuation. And so you get this triple distribution type day. Small distribution, second one, third one. So that's your your currency machine gun. And with any profile trade, with any trade, it's not about being absolute pinpoint rigid on it doing exactly the same thing every time. It's about going into a trade and understanding the context and what it's showing you. So this kind of structure suggests that you can look for that breakout. Now, you can argue about the number of single prints specifically, but what you've got to look at, and one of the best ways I think to always approach this kind of thing is to say to yourself, well, could it be anything else? And when you look at this, it's not a P-shaped day. Arguably, maybe you could have a normal variation day. But a normal variation day, you'd still expect some trade back into this zone. So it's not a P-shape. It's clearly not a trend because we've not already continued to move on. It's not a neutral day. It's not a normal day. So you started to move into the realm of, well, this is probably something else. And the fact of what you've seen so far suggests that this falls much more into what we would call a machine gun day rather than anything else. And so it's always a good way of deducing a conclusion by eliminating others. As soon as you eliminate out all the other options, you kind of end up pushed towards one idea anyway.